All right, let's dive right into this explainer. Today, we're uncovering the hidden mechanics of money. It's time to stop playing like an NPC and actually start winning the financial game. Picture this. You just wrapped up a brutally hard month at work, slaving away flipping burgers or staring at spreadsheets to earn $2,000. You're lying in bed, you check your bank account, and boom, you feel that absolute shock of missing funds. Where on earth did it go? Well, we're going to decode the entire financial system today by walking through 5 key levels of this game. Your first paycheck reality, the truth about banks, invisible forces and resets, trust and the time bomb, and finally, building true lasting wealth. Let's start with level 1, your first paycheck reality, and the invisible forces taking their cut. So that $2,000 you earned, it suddenly drops to exactly $1,456. Why? Taxes. It's that classic modern ritual of giving a chunk of your hard-earned cash away to invisible forces. But look, taxes are strictly the cost of civilization. It's what we pay so the government can build roads, fund schools, make sure your favorite taco truck isn't infested with rats, and, send billion-dollar missiles to places you've literally never been. But where else does that paycheck go? The 2 major culprits are Social Security and Medicare. Now, nearly everyone pays these 2 specific taxes. Think of Social Security as basically government-forced retirement savings that gets paid back to you over time once you retire. Medicare, on the other hand, is a health insurance tax supporting older folks or those with serious health issues. I know it's super frustrating to see your money just disappear, but it is worth noting that countries with higher tax rates do generally see a higher quality of life all around. Before we jump to the next level, we really have to recognize a foundational truth here. Currency is a social construct. Money isn't actually real. A dollar bill only has more legitimacy than a random stick on the ground because society collectively agrees it does. We use it simply because it makes trading and organizing society so much easier. Level 2. The truth about banks. Demystifying the matchmakers. This right here exposes the absolute biggest myth in finance. Check out the expectation versus reality. We all kind of expect our bank to be this giant, impenetrable vault where a dragon guards our deposited money, right? But the reality? Banks aren't safes at all. They're middlemen. They're basically matchmakers taking your money and loaning it out to someone else. They make their profit by lending your cash at a higher interest rate than they pay you to hold it. Let's see how this builds into something called fractional reserve banking, which we can break down into 3 simple steps. Step 1, you deposit $1,000. Step 2, the bank only keeps a tiny $100 fraction of that on hand. Step 3, the bank takes the remaining $900 and loans it to some guy buying a jet ski. This entire system relies on the hope that everyone won't show up asking to withdraw their money at exactly the same time, because when they do, you get a massive system-wide crumble, just like we saw back in 2008. Moving on to level 3, invisible forces and resets. We're talking inflation and economic recessions. So the crucial point here is understanding inflation, that hidden enemy quietly eating away at your purchasing power. Sometimes there's just way too much money floating around. If 2,000 people want the exact same $500 TV, the store's just going to hike the price up to $800. Other times it's supply chain hiccups, making production way more expensive. And honestly, sometimes it's literally just expectations. People expect rising prices, so they spend faster, creating a total self-fulfilling prophecy. This slow erosion of value is exactly why your $5 bill buys way fewer instant noodles today than it used to. And when it gets totally out of hand, governments try to cool off the economy by jacking up interest rates. And that cooling off can lead us straight into a recession, which we can map out on this 4-step timeline. Number 1, the boom. Everyone's dancing, the economy is an absolute party. Number 2, the peak. The lights flicker, reality hits. Number 3, the bust. Jobs vanish, companies cut costs, and the DJ is basically playing sad lo-fi beats about corporate downsizing. Finally, number 4, the reset. Governments lower rates, stimulus arrives, businesses rebuild, and growth resumes. Listen, recessions are just a phase where the economy shrinks for at least 6 months. They aren't forever, they're just painful resets before growth picks back up. Level 4. Trust and the time bomb. Let's navigate interest and credit scores. Interest is essentially money's way of charging rent to exist in someone else's hands. There are 2 main types you gotta understand. Simple interest is super straightforward. Here's a flat fee, thanks for playing. But compound interest, that is wild. It says every dollar I gave you now has clones, and they also want rent. If you owe 20% interest on a credit card and miss a payment, your $12 burrito turns into a $50 regret real quick. But if you're investing, that exact same compound interest is a literal cheat code. turning small gains into massive wins. Then you have this 3-digit shadowy algorithm, ranging from 300 to 850. That's your credit score. It's not about how wealthy you are, it's all about trust. Lenders use it to decide if you'll actually pay them back. Drop below 580 and you are a walking red flag. But cross 750, you sparkle with adult credibility, unlocking things like houses and cars. So how exactly is that trust calculated? Well, payment history is the absolute biggest factor. Do you pay on time? Then there's credit utilization, meaning how much credit you're using versus what's actually available to you. They also look at your credit age, your mix of cards and loans, and how much new credit you've recently applied for. Your credit score is honestly like a pet dog. Ignore it, and it poops all over your life. But take care of it by making your required payments before the late period, and someday it's going to help you buy a house.
Finally, level 5, building true, lasting wealth. The ultimate cheat codes. All right, here is your investing arsenal to combat inflation. You've got stocks, which are tiny ownership slices of companies. Bonds, where you loan money to a government or company for interest. Funds, which bundle collections of stocks and bonds to simplify the whole game. And real estate, which is property you hope someone else pays to live in forever. Listen, investing isn't about getting lucky. It's about trading money for more money by being early, diversified, and incredibly patient. The real danger isn't losing money. It's never investing at all and letting inflation quietly steal your future.
Another absolute cheat code is creating value. Why could Steve Jobs sell iPhones to millions? Or why can Gucci charge 100 times more than Target for a handbag? Perceived value. Think about a shiny yellow rock called gold. It's only worth more than a normal rock because humans place a higher value on it. If you can figure out how to provide massive value to society, you're going to earn massive wealth in return. But you have to remember this fundamental rule. Time is the most valuable asset in the world. True wealth isn't built in days, it's built in decades. Money that sits quietly in an investment multiplies, slowly at first and then faster and faster. That is exactly how ordinary people with modest paychecks manage to retire with 7 figures. They don't beat the system. They use the system and just let their investments multiply over time. Which leaves us with this final, crucial question. Is your interest working for you, or are you working for it? As we've seen throughout this explainer, interest is either your worst enemy or your best unpaid employee. The choice is ultimately in whose hands the interest is collecting. So, now that you've learned the hidden mechanics of this game, what are you going to do with your next paycheck?